Delta is one of the four major option Greeks when you're dealing with options, and when you're dealing with options on stock, or if you're dealing with options on futures, whatever you're dealing with when it's related to options, Delta is a part of that. Delta is one of the four major option Greeks. You have Delta, which I believe is the most important option Greek, and then you also have Gamma, which is a derivative of Delta. It measures the rate of change of Delta. And you have Theta, which is how much you are theoretically making each day based on time decay. It's theoretical because it could, if you have positive Theta, it could come out all in one day or come out in several days. So for example, if you have 100 positive Theta, that means theoretically that's how much you're making each day based on time decay. And if you have negative 100 in Theta, that means how much you are losing theoretically each day in time decay. So if you have positive Theta, you are primarily an option seller like the Dorian Way. If you have negative Theta, that means you are primarily an option buyer. That is not the Dorian Way, because the Dorian Way, we try to act like the insurance company. We want the probability to be on our side, and we're going to talk about that here in a second. You also have Vega. Vega is an option Greek that measures how much you would make or lose based on a 1% change in volatility. So if you had this volatility in the SPX here, the SPX is the S&P 500 cash settled index. Right now it's saying 13% implied volatility. So Vega measures how much your portfolio would theoretically move based on a 1% increase or 1% decrease. So how much you would make or lose based on that 1% increase or decrease. So if you are a primarily option seller, once again, like the Dorian Way, then if your Vega is going to be negative, so if the volatility increases, then theoretically you're going to be losing based on how much your Vega, how much negative number your Vega is. So if your Vega is, let's say, negative 100, then that means you would lose $100 if volatility spiked up 1%, and make $100 if volatility went down 1%. So let's jump into Delta. Delta is the most important option Greek of the four major ones that we just discussed. And Delta is the most important one because Delta measures two things. Delta measures, one, your directional risk, and two, your probability of success. So when I say directional risk, I mean Delta measures how much you would make or lose based on a 1-point move. So for example, if you buy 100 shares of Apple, then you have delta of 100, because delta is one share equals one delta. So if you have 100 shares, then you have positive 100 deltas. If you shorted Apple 100 shares, then you would have negative 100 deltas. So your directional move is the area of risk, or what you fear. So if you buy 100 shares of Apple, then you fear that it's going to go down. So your directional risk is down. And Delta measures how much you would lose based on a 1-point move. So if Apple went down $1 and you owned 100 shares, then you would lose $100, because it's $1 per share. You have 100 shares, so you would lose $100. If Apple moved up $1, then you would make $100 because you have 100 shares. So, but your directional risk is down if you own something, if you own Apple. If you short Apple, if you sell the shares short, then your directional risk is up. Your fear is it's going up. So once again, if you owned 100 shares of Apple and it went up $5, then you would make $500. If it went down $5, then you would lose $500, because you have 100 shares, so you have 100 deltas, and it moves 1 point. So that's your directional risk, or the direction you could make money in. Okay, so that is the directional risk with Delta. That's the basic concept is to just think of it as whatever I own in shares, If I have short deltas, then I'm afraid of it going up. If I have long deltas, I'm afraid of it going down. Then you have something that's called beta weighted portfolio deltas. That means when you beta weight your deltas to something, and most professionals beta weight their portfolio to the S&P 500, the SPX. And so if you had Apple, Tesla, Coca-Cola, and all these different shares of things, and all these different underlines, all these different instruments, you beta weight it to the SPX so that you can know how your portfolio will work based on a 1-point move of the SPX. So when you beta weight it to something, if your beta weighted delta say 1, that means you are long 1 delta of SPX, and if SPX moves up $1, then you would make $1. If SPX moves down $1, then you would lose $1. So when you beta weight it, it tells you how much you would lose based on a 1-point move or how much you would make based on a 1-point move. All right, so let's now move on to talk about delta as a probability, as probability of success, okay? Because I mentioned that delta measures 2 things, your directional risk that we just discussed, and it measures your probability of success. So when you are trading options, you have what is called the at the money line, which is this horizontal orange line on the TastyWorks platform here. If you were on the Thinkorswim platform, that at the money line is where you have this separation of colors at here. Okay, that's the at the money line. It's the same type of concept, just looking at a different platform, trying to give you an idea. Let's go back to this TastyWorks platform, and this is the at the money line. At the money line is where the underlying is currently trading at. All right, so this SPX right here is at the 33.29. That is where the at the money line is. All right, so when you buy something at the money, options or stock, you have a 50-50 chance. Okay, if you buy or sell something at the money, you have a 50-50 shot of making money. It's just a coin flip. Okay, so if you buy Apple or if you buy Tesla, you have a 50-50 chance of it going up. Sometimes it feels like Apple or Tesla just goes up, but in reality, you have a 50-50 shot. Okay, if you buy an option at the money or selling an option at the money, it's basically represents the same type of probability of a 50-50 shot. Where it changed dramatically is when you buy or sell options out of the money. So for example, if we go to this put side here, and this is the put side. If we go to the put side here, and this is the put side, and we decide to buy the 30 delta here, and let me drop this down. This is the 30 delta, and when you are on the TastyWorks platform or Thinkorswim platform and you buy something, it's going to be green like this, and this is the 30 delta. So if you buy something, then you have, when you buy an option, you have whatever that delta is, that is your probability of success when it's out of the money. So if you buy a 30 delta option, then your probability of success is 30%. Okay, you have a 30% chance of making at least 1 cent at expiration. And please keep in mind that probabilities are based on expiration. Okay, they're not based on in between expiration. It's based on expiration and what is the implied volatility at that time and an expected move. So for example, we're looking at the 47 days to expiration here, and the implied volatility right now is 13.3%. And then this right here is the expected move, plus or minus 111. Okay, so no one knows if the SPX or anything that they're trading is going to go up or down, regardless of how many PhDs they have or how long they've been trading in the markets. No one knows if something's going to go up or down. Okay, so but when you are trading options based on what is being bought and sold, all the different options, it creates an implied volatility, and that implied volatility kind of gives you a range of how that underlying is going to trade within that time frame. Once again, this is 47 days, so it's saying within, based on implied volatility right now, an expected move of plus or minus 111 is expected based on these options right now. So probabilities are based on expiration. Okay, so it doesn't mean that you can't make money in between the expiration time, but if you hold this to expiration, your probability of winning when you buy at the 30 delta is a 30%. It's 30%. Okay, so that's not great odds. That's way less than 50%. So if you think that you can buy something far out of the money and be successful, it's not really true. You're being disingenuous or you're fooling yourself. All right. But what's interesting is if you, and excuse me, let's delete this and let's now sell the same strike, that 30 delta. Okay. Now, if you sell this, then it's the inverse of buying. You have a 70% chance of making at least 1 cent at expiration. Okay, even though you are at the same strike. Okay, it is the same strike level. We're looking at 47 days ago, and all of these right here are the strikes, the standardized strikes, and we are currently looking at the 32.45 strike. And when you buy that 32.45 strike, you have a 30% chance of making money, at least 1 cent at expiration, like we just discussed. But if you sell it, you have a 70% chance of making at least 1 cent at expiration. Okay, so what's interesting is, why is it different? Okay, you have to think about that. Why is it different? Why is it that we're looking at the same expiration period, 47 days, the same volatility, the same the strike, standardized strike? We're looking at the same put. Everything is the same, except one we're buying and one we're selling. And the one we're buying is a 30% probability of being successful, and the one we sell is a 70% probability of being successful. The reason is this. Okay, so when you buy something, you need a big move to occur before you win. So you need it to go all the way past your long leg, your long strike here, that 32.45, because you bought it. You need it to go all the way past that. That means the market has to go all the way down before expiration for you to win. Okay, at expiration you need a big move before you win. When you are the seller of that option, you have a 70% chance of winning, because you need a big move to happen before you lose. The only way you lose if it goes past that 32.45 at expiration. Okay, so that if you're holding these things for expiration, these are the probabilities that's what we're discussing here. So if you are the seller, you need a big move to happen before you lose. If you are the buyer, you need a big move to happen before you win. Okay, so it's a subtle difference, but it's a big difference to understand. And the reason why it's that way is because when you are the option seller, you receive the premium up front. The most you can make is up front. So the market has to move, or whatever you're trading, whatever underlying you're trading, has to move big against you before you lose, because you've already made what you can make. It's already into your account. It stays in your account. That say you sold this and you see the $100, that $100 is yours regardless of what happens. And if it goes through the 32.45, you can use that $100 to offset your losses. If you are the buyer, then you paid something out, and it has to have a big move before you win. So this is how it changes the probabilities. So if you're selling something at the 10 delta, then you have a 90% chance of making at least 1 cent. If you buy it, you only have a 10%. If you sell something at the 5 delta, then you have a 95% chance of making at least 1 cent at expiration. If you buy it, you only have a 5% chance of making money at expiration. Okay, you only have a 5% chance of making at least 1 cent if you buy it. Okay, so when you're dealing with options, it's all about statistics, it's all about probabilities, it's about standard deviations. So if you sell something at the 30 delta, you have a 70% chance to make at least 1 cent, or 1 standard deviation chance, and 1 standard deviation is basically 68% of the time. If you sell something at the 5 delta, you have 2 standard deviations, which is basically 95% of the time. Okay, so 3 standard deviations is 99. You can sell that at 99, but it's always trade-offs when you're selling something that gives you a very, very high probability. you are going to always collect less, but your probability is going to be higher. And when you're selling options, it is trade-offs. The probability is on your side, but if you lose, you can theoretically lose a lot more than what you receive. Well, not theoretically, you can lose a lot more than what you receive. I say theoretically because if you're trading the Dorian Way, we have rules and we have adjustment periods based on delta, and you should never lose or have your max loss, because we always get out of things before that is the case. Okay, and if you learn the Dorian Way, you'll understand that we have course 1, course 2, and course 3 to help you trade. The Dorian Way is trading like a hedge fund. We teach you how to trade like a hedge fund manager, a volatility hedge fund manager, a person who trades options primarily for their fund. All right, so that is the probabilities of delta. Let's discuss a few more things about delta. All right, so as I discussed, delta measures how much you would make or lose based on a 1-point move. So for example, you can also look at delta this way. If you have a 30 delta and the SPX moves $1, then that means your option is going to theoretically move 30 cents up or down. So if the SPX moves up $1, then if you sold a put at the 30 delta, then your put option is going to move by 30 cents. Okay, if you bought it at the 30 delta, then your put option is going to lose 30 cents. Okay, because if you sell a put, you are bullish. If you buy a put, you are bearish. So if the SPX goes up and you bought a put, when you bearish, then you would lose 30 cents if it went up $1. Okay, so you've heard of people talking about buying something deep in the money. Let's say you were bullish, you want to buy a call, you wanted to use money to money to come out of your account to be able to make money. So you buy something deep in the money. So let's just say we bought something at the 85. Okay, we bought this 85 call that's deep in the money. All right, so a lot of people think that because they bought something deep in the money, that their probability is higher. Okay, and that's not necessarily the truth, right? When you buy something, you basically have a 50-50 shot of making money. That's your best probabilities of making money, is 50-50 if you buy. You can have higher probabilities if you are the seller, but if you're the buyer, regardless if you're buying in the money, the highest, you're buying at the money, or in the money, the highest probability you can have is 50-50. All right, so this is the 85 delta that we're looking at here. Once again, this is the delta, and that means that this option is going to move 85 cents for every dollar that the SPX moves. But even if it was 100, if that delta was 100, that would mean it would move $1 for every dollar the SPX moves. And you can get an option that moves basically like that. But that's just still a 50-50 shot, because when you buy an option, it's still going to cost you some money. If you buy something deep in the money, it's going to cost you some money to do that. And the only difference from buying something in the money and buying something out of the money is that if it expires when you're still in the money, then it still has some value. It's not worth zero. It's not worthless. We heard about options expiring worthless. Well, if it's still in the money, then it's not going to expire worthless. But that doesn't mean you have won, right? Because you've paid something for that option and you probably still lost because it's only a 50-50 shot. And keep in mind like this, even if I had 100 delta, right, that's just like buying stock. It's going to be a little cheaper because it's an option, because it has expiration, but it's still just like buying stock. So if I bought a stock, if I bought like Apple, then I still have a 50-50 shot of making money. It's still just a coin flip, okay? Regardless of what you might think of Apple or whatever stock or company you're buying, if you're buying their shares, it's still just a 50-50 shot if you're going to win or lose on it. Okay. All right. So that is the probabilities of delta, how the probabilities of delta work and how the directional risk works. And once again, delta is one of the 4 major option Greeks, and the delta is the most important option Greek in my opinion, because delta once again measures your directional risk and your probability of success. So if you're going to be a buyer of options, you should buy at the money or at least a couple of strikes in the money. You don't want to buy out of the money because your probabilities will be less than 50, and you want to have at least a coin flipping chance to make money. But if you're an option seller, if you sell something out of the money, your probabilities increase. So selling something out of the money at the 30, 25, 20, 15, 10, 5 delta is ideal. When you trade the Dorian Way, we primarily sell things between the 5 and the 7 delta, and we also sell things between the 10 and the 15 delta, but primarily between the 5 and the 7 delta. So we have very high probabilities, at least an 85% chance of making at least 1 cent in expiration based on the probabilities when we initiate the trade. If you enjoyed this video, please like and subscribe to our channel. In the description below, we have provided a link to our courses and to our website that provides information on the one-on-one mentoring we offer. Thanks again for watching, and see you next time.